The public's interest in dividend investing, and more specifically, dividend growth investing, seems to wax and wane every couple of years, depending on the economy and depending on investor sentiment. Just 6 to 9 months ago, few in the press were discussing the group of stocks with enthusiasm, while many were extolling the virtues of growth entity price stocks or valuing stocks on TAM, which stands for Total Addressable Market. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group in Houston, Texas, and this is our investment team's midweek release when we examine a news item, headline, or story, making the rounds publicly available sources, and we ask, is it news or is it noise for your investment portfolio? This week's topic is, do dividends matter? About a week ago, the big retailer Target said it would raise its quarterly dividend 20% to $1.08 a share from 90 cents a share. This new dividend will be payable as of September 10th to shareholders who own the stock as of August 17th. Based on the stock price of around $152 a share, the new annual dividend rate implies a yield of about 2.85%. This yield compares to the yield on the S&P 500 of around 1.6%. Admittingly, this dividend hike comes after Target lowered its earnings guidance for the second time in less than a month. Over time periods measured in years, dividends matter. Many dividend-paying companies tend to steadily grow their dividends over time. Well-established companies that pay dividends typically increase their dividend payouts from year to year. Many investors fail to appreciate dividends' significant impact on stock market returns. From 1980 through 2019, almost 75% of the returns of the S&P 500 came from dividends and their reinvestment. In addition to investment enhancement and compounding, a strategy of owning some dividend-paying and dividend growth companies has played a factor in reducing overall portfolio risk and volatility. Studies have shown that historically dividend-paying stocks outperform non-dividend-paying stocks during bear markets and recessionary periods. While almost no stock is immune to market corrections in bear markets, dividend-paying stocks usually suffer significantly less decline in value than non-dividend-paying stocks. Are stories like the recent one of Target raising its dividend news for your investments? Absolutely. Dividends matter for your overall investment returns, particularly during market corrections, bear markets, or recessionary periods. However, remember that dividends are only one component of your total investment return. Having a company pay you a high stated dividend of 5 or 10%, while the company's stock drops 5 to 10% per year, doesn't do you any good. This is a characteristic of a classic value trap, where a company has flat to negative revenue growth at the same time it's still trying to spend money to grow and still spending money to pay you a dividend and its other shareholders. Try best to avoid these types of situations that are optically high-yielding stocks, but when capital depreciation is factored in, your overall total return is negative year after year. At Oak Harvest, we think our clients are best served by us helping them with their future needs instead of focusing on the past. The future is always uncertain, and that is why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Call us here at 877-896-0040 and schedule an advisor consultation. We are here to help you on your financial journey into and through your retirement years. I'm Chris Parrish, and for the whole team here at Oak Harvest, have a blessed week.